How to borrow more? That's the biggest question we all have as property investors. We get to a point, we have 1, 2, 3 properties, and they kind of get stuck. We have this glass ceiling on funds that exists out there. For anyone that has been a property investor for a while, they will know exactly what I'm talking about. And the question is, how do we borrow more? How do we go beyond to be able to lend more? Because the rate of which we are paying our interest is lower than the rate of which our properties are growing. So we are better served to have more investment properties, to have more debt. But the problem is some banks, and this is where it gets a little bit spicy, this is what we talk about in the session, is some banks are not the best for borrowing when you start out, and some banks are better when you're further down the investment journey. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Oz Property Investors, Australia's largest property investment community with over 79,000 members now, which is pretty cool. Each week, we interview top property experts. Tonight is no different. We have Aaron Whybrow of Strategic Mortgage Brokers, and he's an absolute legend in the lending space. Now, this session is, I think it's foundational for anyone that's starting out property investing to get a full holistic understanding of how the lending landscape works, and anyone that's further along in their journey, some of the tips and tricks that they can use to be able to borrow more and borrow more and borrow more. Obviously you need to do it safe and securely, but that's exactly what this session is. We talk about self-managed super funds, we talk about trust lending, we talk about how to structure the debt, how to pay down debt. Should we be paying off our PPOR? Should we be doing this whole debt recycling thing? What the hell is that all about? It's action-packed. There's so much stuff in here. Let's jump into the session and make it happen.
And we are live on Oz Property Investor. We bring the big names and we have the big fun. How's it go? Tonight we have a big... I was going to ask you how you're going, but first, I think it's important that we unpack a topic, which is... I know a lot of people talk about trust, but we're going to talk about that towards the end. But first, we need to understand well, what is happening in lending and how to borrow more in 2025. And what that's going to entail is going to be talking about, well, what do debts mean and how to extend and improve that borrowing capacity? But also around, well, when do you need to consider moving from one broker to another? So a big packed session around financial freedom tonight. But how are you going, Aaron? What's happening?
Going well. I'm talking to you guys. That's pretty cool. It's been a busy start to the year, I can tell you that.
Busy. What are you seeing out there in? Oh, I better ask Joe how's it going. How are you going, Joe? Are you busy as well? Is everybody busy except me?
Except you, Jeff. I think so. Maybe that's the case, mate. I'm flat out like a lizard drinking. It's a very interesting game. This property one. That's everything is always shifting, changing, and moving. One of the things I think everyone's seeing out there, right, is prices are increasing for assets, which is then pushing up the yields, pushing down the yields because it's more expensive and the rent it remains the same, at least in the first year of that lease. And what that means from a borrowing perspective is you can't borrow as much money because you now have more debt. So these type of conversations on how to get strategic as a property investor become pretty valuable. But how are you, Jeff? Look, mate, you got new hair. You've done it up. This is weird. You've ironed a shirt. God.
No, I haven't. I hadn't on the shirt, but definitely. Thank you for acknowledging my hair, Joe. No, going really well, and just building. Some exciting things are coming down the pipeline. Maybe Oz Property is buying some more property. Who knows? Who'd have thought that might have happened? But they're going really well. And I wanted to. We spoke about this before the show. We said we're going to put the disclaimer. So this is general information. General nature only. It should not be taken as professional advice, and you should go and seek your own financial advisors for tax and broking and all that sort of stuff. We're not responsible for any loss caused by this. So there we go. But no, going well.
I like when a session starts with that. It knows that there's going to be some juicy stuff to come.
Yeah,
stay tuned.
So make sure you drop your questions. If you're struggling with lending, let us know what it is. It borrowing capacity or is it deposit side? I want to know what people are, because we'll crowdsource some of these and throw some curly questions at Aaron as well. But for those of you tonight that are watching at home who haven't seen Aaron floating around, he's the broker for Oz Property Investors, and well, the portfolio at least. I don't know going to say you're official broker of us, but you are the managing MD of Strategic Mortgage Brokers. You've been in the game for over 13 years, and you have an MBA and a Bachelor of Nursing as well. So you do a lot of things. You are as well training assessment, and you have, I suppose, your own portfolio as well. You're building an empire of your own. So, and you're also the bag piping broker. So lots of things you get, and you also got your 3 beautiful kids as well. So there you go. Better intro this week.
Well, if we've got. It looks like Greg's there. I'll get on to the bagpipes for him on his comment, and shoot it through to you guys at some point when I'm invited back on. He'll get some bagpipes.
I'm excited.
Yeah.
So Joe, what do you want to ask Aaron first up? I mean, I've got plenty of questions, but I reckon I'd love to hear what Joe was asking. A great question. Put him on the spot.
No, you go, mate. You've got all the questions lined up. I just come here to.
Well, first off, I want to know, because we are at the start of almost the start of New Year. It's February. But so what are you seeing out there in lending land? Because I think I love to see and hear the insights. I think that is lending getting easier? Is it getting harder? Like, what things are you seeing and hearing from lenders and from credit teams?
It's an interesting question from you, Jeff. If you can, there's two ways to think about it. If you can meet the lending income assessments, the lenders will throw you money. Like, I know that sounds like an hors but there are some lending out there, like 95% LVRs for some people, for investors. There's changes in some of the professions to get waivers of mortgage insurance, like nurses, for example. There is treatment of debts that aren't with the bank that you're going with. There was some comments I saw recently with if the banks can reduce their 3% buffer for new money. Well, there actually is banks that aren't regulated by APRA that actually have a 2 or a 1% buffer. So it's just bringing, it's either for 2025, it's bringing to the surface some of the stuff that was there before, and some of the new stuff that's out there. Like, there is a little bit of a crazy cool thing maybe with 40-year loan terms.
Cool.
And that can play a thing. There's a lot of I'm seeing a lot of my social media blow up about sell that damn owner occupied property and get it out of there, so you can get your borrowing capacity up. Like, there's a lot of stuff out there.
That's juicy.
Yeah.
I kind of want to pull on that thread with the selling the owner occupied, because that is quite controversial. Because why is there that push towards that? Isn't the answer just to earn more money?
No. Well, that can be a cool solution too. But what about I'll show you a quick scenario on how the owner occupied mortgage can affect your borrowing capacity. How about that?
Yeah, go for it.
Go on, share away.
Yeah, cool.
Hit share and try it, and we'll bring it up.
Hit share and try.
Okay,
it.
So what are you going to show us? Like a little box drawing.
No, I got typing this time. I went down the line of buttoning up my shirt and putting some typing in here as well.
Wow.
So let's deal with a quick scenario. Single person, 170 grand of income, rental income of 70 grand. So proposing to buy property and got a property. He's got a new loan that he needs of 600, an owner occupied mortgage and an investment loan. So there's some data here just to show you the context of the next part of what the owner, whether he buys an investment or another owner or another.
Okay. So one PPOR with only 300 grand of debt, and then he's got an investment property that's bringing him a pretty solid rental yield, but that's got $500,000 worth of debt.
There's two rents. The first property is bringing in about 30. The next one's going to bring in about 40 grand a year. So if he chooses an owner occupied versus an investment, this is what happens. So here we go.
Wait. He's choosing.
Wait.
Does he already have an owner occupier?
Yeah, he's choosing to upgrade his owner occ or buy another investment.
And then what happens to the owner occupied mortgage on that one? Does it become an investment loan?
In this case, it will. So
cool.
If we go no owner occupied, he's going to get another $196,000 worth of borrowing. If he chooses owner occupied, he's going to get $196,000 less borrowing.
Interesting. That's actually I thought it would have been more than that, because That's not have it. Yeah, I thought it would have been like I mean, this I suppose with the big four banks. Like, are there lenders out there where it's a $300,000 to $400,000 difference?
Well, if we escalate it out to being like higher LVRs, higher rates, and without other investment debt and a few other things, it does probably change higher to have it.
Yep.
So that's an interesting point with the owner occupied. It is a thing that if you can get more deductible debt than non-deductible debt, it does help you in the borrowing capacity.
There you go.
Yeah,
well, that's crazy. So it's not as not as big as what I would have thought. Like I thought it was I mean, it does help. I mean, I'm not saying that doesn't, but there we go. So
yeah.
where do you want to go from here, Joe? Like, what are you all kind of?
So
There's a lot of things that we've thrown.
Well, I mean, this is one of the things, right? So you own an owner occupier. Like, I have conversations with investors all the time, and there are a lot of people out there, and this might be you actually. Is I live in Sydney. I love Sydney, and I can't afford to buy a house in Sydney. It's going to cost me $3 million. So what do? Do I get a little shoebox 1-bedroom apartment and try to build up my portfolio? But then I look at the capital growth of units, which is 4% annual growth, and then houses at 7% annual growth. It is stupid for me to buy this little shoebox unit. Why don't I invest out there in the real world? So I guess one of the questions is, should we sell down our little shoebox, get rid of that owner-occupier debt and turn it into investment debt? Because we're thinking in 10 years' time, I'm going to be able to build a portfolio because all of my money, all of my borrowing ability and serviceability and all my cash is tied up with this owner-occupier unit that's not growing. Why don't I just transition that to investment? Like, would that be from a purely numbers perspective? So we're taking the emotional element out of this, but would that make sense, even though you still have to pay rent?
The interesting part about doing the numbers on the repayment on moving. So we've had a lot of customers come in with one owner occupied and one or two investment properties, and they get stuck. They have it all owned in their own name. They then have to make choices of what they're willing to do, whether they're going to change the owner-occupied debt, or are they going to sell down a property? Are they going to restructure things out into structures to help them go to the next thing? So they're on sort of decent incomes and they've got lots of cash deposits, and how they deal with that. And there's a whole range of things to deal with there. Then I'm seeing a few clients come in on the reverse, where they hate the landlord putting up the rent. Those damn landlords putting up rent, holy moly. And they said, oh, we've had the rent increase $60 a week in the last 12 months. And I'm going, how much are you paying now? And they say, oh, about $700. And I said, what's your property worth? And they go, about $900. And we go, what's an 80% lend on that at the current interest rate? So they're not going to be paying $700. They're probably going to be paying closer to $1,000. So, and then they're going to have all the other costs associated with the owner occupied. So numbers actually help you get the data to make the sense. And then you got people that actually want to have a balance between investing and actually living. So let's have the owner occupied. Maybe it's around the corner from the school for kids. Maybe it's because it's got some sort of stability, or it's an old school thinking to have it. And investing takes a little bit more time. But then you've got the people that come into some cash, and they've still got an owner occupied debt. So there's ways that we can go down that rabbit hole to see how we can convert non-deductible debt into deductible.
Yeah.
So
debt recycling.
Debt recycling, is it?
Yeah.
Can you give us a breakdown of what debt recycling is? And like, I've heard it explained a number of times, and it feels very complex at times. So if you could break it down simply, that would be lovely. Oh, we've even got a slide. Okay,
a bit like this.
Here we go.
A bit like this.
Here's one I prepared earlier.
A bit like this.
So if we take a starting point, all right. So we got a home loan, $800K, and we got some cash that we want to use for investments. So one way that most people will think about, let's just take the $400K and we'll just go throw it on a few properties, right? And we'll keep the $800,000 home loan debt, right? So what if we did it a bit differently? What if we used the $400K and reduced the home loan, in essence paying it off, and then had the ability to restructure the debt to have it a home loan for 400 and an investment loan for 400 with an offset account to help reduce the costs, while people like you, Joe, are finding some properties out there for them to spend their deposit on. So in essence, what we've done here is we haven't just thrown the cash onto the property. We've actually now got 400 grand of non-deductible debt and 400 grand of deductible debt, restructured in the right way for accountants and ATO to see it in an audible trail. And then what happened with this? We get a change in borrowing capacity by around 82,700 for our client here. So 82,706. Now we're seeing some small numbers of change in borrowing capacity. It may not be worth it. And we're talking 400 grand here. So I'll show you how 100 grand and 200 grand work in borrowing capacity, recycling and things. But 82 grand could be like stamp duty, buyer's agent fee, holding cost of the property, part of a deposit. There's a whole range of things that can come in there. But if we go for 100 grand or 200 grand, we can see that the borrowing capacity will change a little bit, but it still has an effect of eroding away the non-deductible owner-occupied debt.
Well, one of the things that I've always been told when it comes to is pay down your owner-occupied debt as much as possible, because that's the non-deductible debt. So how do I think about this now? Because what you're telling me is, no, Joe, pay down as much as you can, but then convert that into an investment. Why would I do that?
So this 400 grand is considered more disastrous on the borrowing capacity calculator than this 400 grand. And if we didn't put the cash in there, we would still end up with an $800,000 home loan. So even though it changes your borrowing capacity a bit, considering our guy for investment here, it's getting that owner occupied down and having the interest to add back onto the calculators for the lenders. So you can choose whatever you want. There's a good way to do it, and then there's a way to do it, or not a good way to do it. But for me, I always, any spare cash, it stays in the offset account to a point where I can recycle it through the owner occupied mortgage to buy more investments.
Yeah, okay. There you go. And
if you do it 2 or 3 times, it changes everything.
You want to be chatting to your accountant to make sure everything, but yeah, that sort of gives. I think that gives a very great way of looking at it, and it's all what I'm picking up here is it's about getting that extra borrowing capacity, because if there's 2 ways you can think about it. You can increase that borrowing capacity, you can increase the deposit size, which is one way of buying more property. But of course, you need income to do that, or you can increase the borrowing capacity. So there's kind of 2 ways. There's 2 resources when you're talking to your broker. The thing we talk about, and Joe talks a little bit, I talk about it a little bit as well, is you want to think 1 to 2 purchases ahead. How should people start to have those conversations with their brokers? Like, is it okay? Here's what I'm earning. Here's what I need to do. Yeah, what does that look like?
Yeah, so the biggest thing with so there is a theory out there that sometimes people will test a broker to see if they actually have the knowledge to help, and so sort of probably okay to do that. I've been requested a few times for my credit guide up front before they want to have a phone call with me and a few other things, and that's not a bad thing to
send them one of these videos. Qualified. You buddy break it down pretty good for us.
Yeah. So the thing for prospective borrowers to check out a broker is that you need to reveal all your goals. If you have a goal to buy an investment property, all right, so I'm just going to go buy an investment property. I'll come to you, Joe. I'm going to buy an investment property. Just tell me what my borrowing capacity is. That's probably not enough information. It's like, hey, Joe, I need my borrowing capacity because I have a goal of, let's pick on, I have a goal to get $150,000 passive income. All right. And then Joe, you go off and you do my numbers and it comes out at $1 million. So that's probably not enough borrowing capacity to get to $150,000 passive income.
Yep.
So you're probably going to have to think now, the lender that I choose for this property I want to purchase now needs to be in the context of the second and third property.
Yeah.
Because if I'm going to choose, we pick on one of the flexible lenders. If I'm going to choose First Mac up front, I may lose the ability to get its benefits for the second, third, or fourth property, depending on where they want to sit in the scheme of things.
Why is that?
Yeah, so some banks actually treat the debt of other banks more lenient than their own debt.
Yeah. It's the interest only sort of periods where you start to that's where you can potentially get yourself a little bit stuck, because you don't want to sort of go absolutely to the hilt and then get interest only lending and then go the other lender say, yeah, I can consider that at actuals, and then you sort of start to say, oh, look, my circumstances changed, interest rates have gone up. So I think that's it's an interesting point. And
I just want to stick on this, these questions to ask a broker that's going to give you the best bang for your buck, because I think this is where a lot of people get stuck. And then all of a sudden, you've just told me, if I go to my broker, like in life, you ask better questions, you get better answers. Wholeheartedly true for anything. And you also get taken a little bit more seriously. Like I was just literally today, I was doing a deep dive into a development deal. And I called up the council and it was like, I already know that I've got the frontage, the setbacks, the easements, the blah, 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 all of this. And then all of a sudden I'm having a much more engaging conversation with the town planner. So you guys have to kind of go in with better questions and better information. So what is the dream client coming to you, and what do those questions look like that they should be asking you to get the best out of the advice that you give, information or advice that you give?
Yeah. So the way the broker's got to help you extract the information as well. So a savvy broker looking at investments and other things has to be able to quiz you a bit and understand where you've come from. And similar to your conversation with the council, if you come to a broker and you say, I've got this, and this, I've had to go at buying property in my name, it didn't work, and I sold it off, I had the wrong advice, I didn't like the lending, and it just got out of control, the cash flow. I then know that I can extract information like maybe I need to focus a bit more on the cash flow. I need to make sure that every fee that's involved in purchasing the loan is put into the system. So if you tell the broker where you've come from, tell your broker where you're going with the goals. Like you guys, if you come in and you go, I want 150 grand of passive income, well, then we can calculate what the assets that need to be unencumbered from. We know we have this much time period to build up the property portfolio, and then how to retire the debt on the other end. So that helps map that out a little bit more. And then,
so what are those things? What are we saying to? What are we giving? So, what do I give you?
Do you have a passive income goal? What do you have value of property you want to buy? A lot of the large property investors that we look after, they may just have this box to tick. They might be at $5 million property, $2 million in property. They just want to get the 5 million, or they just want to get the 7 million. That's their tick box. So sometimes it can be a bit of a game. Sometimes legacy play comes into it. A lot of families or mums and dads that come into the business here, they want to have a legacy play. How do we pass down some wealth to the kids? And the most recent one that I've been talking to a lot of investors that are parents, and the kids are getting older now, getting their own career, and it's always, everyone says you should get into property earlier. So how about 18, 19 and 20? How about a little bit of into legacy stuff? We're doing a lot of family guarantor loans on investment properties for kids to help them get into property without deposit. So legacy play, helping the kids, what income they want later in life.
Best thing ever.
Passive income.
If you're a young kid right now and you're listening to this, good on you for picking up the podcast and trying to make this stuff happen. But you can get a guarantor loan. That was my first investment property. I bought a property for $280,000 that needed renovation work. I saved my ass off and had $60K. So I could have bought a property, but I wouldn't have been able to afford the renovation. So if you use the guarantor loan, what I did was $280,000 for the guarantor loan. And then I used the $60,000 to renovate the property, and that released mum's equity, like released the guarantor loan when I got it revalued. So think strategically about if you are young or you are older and you want to help your kids out. There's not as much risk. There is risk, don't get me wrong, but
definitely risk.
Let's unpack that a little bit more there, Joe. Like for the kid getting a guarantor loan, perfectly fine. That's great. If they got cash or the parents want to be a little bit more secure, maybe they just do the 105% loan and they take the cash from the kids for security if they want to, or you can, in your case, do the renos, and that's great. But the thing is when talking to parents, the parents need to set it up in a way that they don't take all the equity out of their owner-occupied mortgage or a property they're going to use to do the guarantee. So Here's the stuff that some people don't, that not many people talk about. The
So this is
guarantor's property,
mum and dad, the investor, are still
that's
keen
right.
on buying their
Yep.
portfolio.
Yep.
Oh, okay.
Yeah.
Go
Yeah.
on.
So we're unpacking this at the moment, that we don't want to take too much of the equity out of the property that they want to use as the guarantor for the kids. So the banks won't expose the guarantor past about 70% loan to value ratio.
Yep.
So we have to have, if we've got a $500,000 property, the bank will allow you to guarantee around 25%. And then 80% of the loan is secured by the home with the person that's borrowing the money. So it's a limited guarantee. So that $500,000 loan would have to be like $100,000 would have to be still within the 70% of the guarantor's property to be able to do it. So when we're looking at goals for, say, we want to help our kids, if you tell the broker up front, then we're not going to extend the LVR past what's going to be able to help the kids if that's in the next 6 or 12 months.
That's why those goals and questions coming to you up front. So what it looks like from, like, what I've gathered from this is, hey, Aaron, my name's Joe. I'm in my 30s. I'm looking to retire at age 50 with $150,000 of passive income. I'm earning 150 grand. My missus is earning 80. I want to know what my borrowing capacity is. And you're going to say, Joe, you've got $1 million of borrowing capacity. And then my question is, well, then only $1 million. How do I then get to from $1 million? So I'm going to buy, what's that? 2 properties. I'm going to buy 2 $500,000 properties. And then what? What do I?
Yeah. So like that. So when you've said the specific thing about passive income, 150 grand, we know that we can randomly, well, not randomly. The 5% return on 3 million is 150 grand with no debt. Right. That's the gross income. Obviously, with property, you need property expenses and things like that. So it's probably not going to be $3 million worth of assets. We also know that there's time that can come into the picture as well. So there may be, there's obviously interest only and principal and interest, whichever way you go, and paying down the debt. There's time for rentals to go up and equity to increase. So those are big factors that come into the compounding effect of the property portfolio. If your income doesn't change, but you're able to generate the deposits and able to generate the equity, then it's all about where you hold your debt. So there's good reasons to have debt in your own name, owner-occupied mortgage, capital gains tax stuff. It's good to potentially have something else in your own name for any tax deductions and tick the box for the accountants out there. And then you've got 2 other areas that you can put debt into. So that's when, how does the impact of your $1 million borrowing capacity now to get your 150 grand of passive income? We are going to be guaranteed to get into structures, trust structures, company structures, whichever type of asset and cash flow you got. And then we're also going to get into the other area of its own unique borrowing capacity, which is in self-managed super funds, because it's a pretty isolated, regulated area, but it has its own borrowing capacity. So it can be outside your personal borrowing capacity and outside your personal capacity with trust as well. So when you say $1 million worth of borrowing capacity, that could just be you doing a calculator online, or you've just asked the bank or anything like that. Then it's really unpacking it. Okay, I'm going to put the debt here and it's going to help me do this. I'm going to put it here and it's going to help me get to the goal of 150 grand. And that's where, if you tell us up front, we got it.
Yeah. Well, I guess when I asked where are you going, Jeff?
I was going to say, well, that speaks to the title, because to me, you've actually outlined there how to borrow more in 2025. You kind of, a lot of people say, okay, I can only borrow $1 million, but then what else can you consider? Is it a trust structure? And you speak to your accountants, and then speak to your fin planner maybe, and then you can consider the self-managed super fund, depending on your age and how long you've been in the workforce. So it's, yes, you want that $3 million by 50. By retiring at 50 show. And yes, if it's in the SMSF, it's harder to get there in terms of, because you're probably not going to be access it. But that's how we're kind of answering the question. There was a good question come up.
Before this question, put it in context too. Like, if you want 150 grand of passive income and you're able to get to say 100 grand of passive income in your own name, but you've made some decisions to potentially, if it's suitable for you, put a property in super with a loan. You might get to if you get to age 50 at 100 grand of passive income, you know that in the next 16 years or wherever it's going to hit, that the super fund will kick in as well. So it's personal kicks in some parts, trust kick in some parts, and super kicks in probably at more of an age part, but it still will kick in to help you cover that whole period of life and retire early, right?
Just before we jump to the next question, one of the ones that I wanted answered is I have that one I just told you. I have $1 million of borrowing capacity. How should I think about that? Because when I hear that I have $1 million, oh great, I need to buy 2 500s and that's it. Like, how do you think about it from a flexibility standpoint? Because it's not like this purchase isn't going to be 500 and the next purchase isn't going to be 500. You could probably borrow more. Is there like a percentage that you think about it for? Like, actually right now you can borrow $1 million, but if you went with a different lender, you could borrow 1.3.
So that's where staging, when we understand the goal. So we understand the goal: 150 grand passive income, $1 million worth of borrowing capacity. Now, how do I start? Well, we're probably going to start in sequence. So we're not going to buy 2 at once. You can, if you want, and spend some time on it and be badgered with 2 financial cooling off periods and a bucket load of documents, and you may have to take a day off work to get the documents in the right spot because banks are a little crazy when you do it this way. But you might buy one property. I've seen it before where you do the valuation on the property. It may be untenanted, but it needs a paint job or whatever it is to be able to increase the rent. So you might buy a property and it's got $450 a week in rent. So we have to approve the loan with the 450 because the bank takes the lower of the rent. We get it approved. We get the $500,000 property done. You do a little bit of a paint job, whatever you need to do. Now you can get $550 worth of rent per week after settlement. So immediately your borrowing capacity numbers are changed upwards pretty quickly to be able to readjust the numbers. So where the work of an investment broker comes in is that settlement. Like, what's your next goal? Are we going for the next one? Is there any changes to the rental income that we can see? Are you able to achieve the rental incomes that were chatted about with the buyer's agent and everyone beforehand? When is it going to kick in? Okay, cool. We're going to go borrowing capacity changes to this. Then we can go to the next one and use a bit more of that $1 million borrowing capacity to get the next one. And maybe the next one's like the same thing, a little bit less on the rent, a bit more after settlement because of a lease change, whatever. And that's the compounding effect. So you could, if you got enough income and enough borrowing capacity, say past the 1 million or up to the 2 million, and you only want to start with the million and go for 2 at once, absolutely go for whatever you want. Go for $1 million property if you like. And there's no wrong or right here. It's getting the right advice and the right due diligence on the property. But you can, if you're starting out, do one and then get your borrowing capacity reshaped. And for anything that you've got valuation uplift in property, Joe, you've got valuation uplift in property already, and potentially rental value uplift as well. So that changes your borrowing capacity, right? I think you explained some of those.
I think I might have some uplift as well, Aaron. But the borrowing need to probably increase that income though. I think based on what I got. So I want to know. Let's go back to this question. Resetting, because this is from
cool question.
Kingsley. He's asking us, are you resetting the owner-occupied loan term as well, or running interest only in your model? I don't know if you interest only for your own rock. I didn't think that was was a little bit tough to do. But how are you kind of resetting both for that, or what does that look like?
Resetting loan terms is definitely an option. Like if you've paid your mortgage down to like 10 years, 15 years, and then if you take Joe's example of $1 million of lending and 150 grand of income, but your owner occupied's at 10 years, like you're potentially not going to get that $1 million if you don't reset the loan term. So resetting loan terms is an interesting conversation out there. There's a few people going, don't reset your loan terms. You're going to pay more over the long term. You're going to pay double your interest over the life of the loan. So you buy a $500,000 house, you're going to pay $600,000 worth of interest on top of the principal. So $1.1 million paid back over 30 years.
Yeah, of course.
But if you're able to put your money to work in investing, it changes the whole game.
Yeah.
All right.
Yeah.
Even debt consolidating, say a credit card or a personal loan or a car loan, and using the extra borrowing capacity to invest. What are you seeing as a capital growth on property? I can't put capital growth in a borrowing capacity calculator, but what are you seeing on average, Joe, on capital growth?
Well, what do I see average? On average, over the past 12 months, we performed 21% capital growth. Australia has performed at 6%. So, so 6% overall is probably what, normal people out there should expect to go out there and get. Yeah. But
So if
that's
you're
still,
getting good,
and we run scenarios at 5%, right? Like a 5% compounding growth. So if you get in 21, that's just that juice. Like, look at our Townsville property, Jeff. Like that one that we bought, we paid, what was it, 435,000? That's now valued at 495,000 6 months later.
yeah.
Um,
So if we
I thought
went,
you weren't talking about Townsville though.
so if we take that growth uplift,
Funny
would
way.
you, in hindsight, knowing you got growth uplift, if you had to reset your owner occupied mortgage from 10 years or 20 years or 25 years back to 30 years to be able to achieve that purchase, would you?
well, yeah, for you
Yeah.
know, tens of thousands of dollars,
Right.
but also
So
like property investing is not easy. Like this is
no,
very difficult, and especially when interest rates are at this level, like it's a tough go at the start. Like anyone that I see, they're like, oh, I've got 4 properties in my portfolio and I started 3 years ago. Oh man, I'm sorry. Sorry to hear. You're in the
so,
tough zone at the moment. But in 10 years' time, you're going to be in a far better situation than than otherwise.
so
How is everybody?
with,
How is everybody feeling out? Like, I want to know, are people sort of struggling? Because I love getting a bit of barometer check. We have
so it's
most.
that's an interesting question too. But with the extension of owner occupied mortgage loan terms, you can do it, and you can do it in a really cool, controlled way. If you
Right.
are on 20 years beforehand and we're resetting into 30 years so you can invest, you can still continue to pay your owner occupied mortgage at 20 years if you like. There's no restriction on the
Yeah.
bank for you to pay more. Like, let's
Correct.
be smart about this. If you
Great
really
point.
want to knock that loan term down, pay it at the loan term it was when you originally got it, and then let the borrowing capacity talk its numbers to you so that you can engage and get a property that's going to go up in value as well at the same rate you're paying the mortgage down beforehand, even though there's a little bit of flexibility in the calculator and the loan now because it's now back to 30 years, for example.
Yeah.
Yeah. And you can
Investors
offset
learn from it.
all of that money and not pay
Mhm.
that interest. And you can,
Cool.
I mean, obviously you will have more debt that you need to be paying on, but you will also be getting more rental income, and then you'll be getting more capital growth on that debt because it's just sat there doing nothing otherwise. It's just paying down your
That's
owner
right.
occupier, and then you get there in 30 years time. Like I have this situation with like older investors, not older investors, older people that have had their owner occupier. They've done what they've been told to do: get a good job, work your ass off, have kids, pay down your owner occupier mortgage, and live your best life. Well, I love my property. I don't want to sell down. I've got all of this money tied up. I can't I'm stuck with it now because I want to now cash out, but I want to live where I want to live, and they can't
Just
cash
rent,
out.
Joe?
Yeah. There you
Can't
go.
we rent? Can't we sell and rent
Yeah,
somewhere
good luck.
where you want to
Imagine
live?
living your life in your house for 30 years, 40 years, and then go rent. But you may want to downsize and do that kind of stuff, but it doesn't give you that kind of lifestyle doing it that way.
I'm a millennial, I suppose.
So temperament out there, Jeff, what do you?
Like the temperature, like I'm getting like because I went to a barbecue with a birthday on the weekend,
Cool.
and the vibe that I was getting is that there isn't actually a lot of like people are starting to really feel a pinch a little bit, like and it's a word on the street, and this is in Sydney, so I'm not saying it's generally around the country, but we're not talking like Double Bay, we're not talking Rose Bay, we're not talking Mossman here, we're talking kind of the mortgage belt of Western Sydney, and even those where you can probably pick up a house between 800 to $1 million, people are like, well, how do I buy a house that's not an absolute sort of dump that I need to then renovate? And even that, I still have to pay people still paying 700 to 800,000 for these properties. So that's why I suppose I asked the question. But I do have a question about, I suppose, debts that may help some people. But I want to know,
Go
like,
on.
do you guys actually think that when rates likely they will get reduced in a couple of weeks' time in the February meeting? But are you seeing people waiting on the sidelines and waiting to gear up to go and buy property? Or I just don't see it happening. Like, it's not going to move the needle that much.
Yeah. I suppose how much they reduce it by could help, but with people on the sidelines waiting for rates to come down, I think there's a few vendors out there, people that got property wanting to sell, are waiting for the rates to come down and have some to see if there are more people who have borrowing capacity. But I don't see it changing borrowing capacity that much at all. I don't see rates coming down going to uplift the borrowing capacity that much, anywhere between 2, 5, or even 10%, depending on the amount that it reduces by. If it reduces by 0.25, some of the lenders are giving you interest rate reductions or pricing benefits of that level if you haven't had pricing for a while. But it's not going to change borrowing capacity, because as the interest rates went up, they went up by a thing called cost of living. And what else goes up in the borrowing capacity calculator is the household expenditure measure, living expenses that come out of one of the universities in Melbourne that the lenders use. So the HEM. So if the living expenses are going up because of cost of living, and the interest rates drop because the cost of living is coming down, but it's not potentially going to come down in the living costs in the calculator. So what was, say, 5.5% when it was coming up and it got to 5.5%, when that calculator is going to be far more lenient when it was coming up than when we go down to 5.5% when it drops to that level. Now, if it drops, so economists, like all the major banks, are saying that we're tipped to have an interest rate cut in February, but we also know economists is that job that they can be wrong and still keep their job.
Yeah. What are your thoughts, Aaron? You think they're going to drop them?
I want it cut. I've got mortgages, mate. I need it cut. Cut it down. Give me a less cost on a mortgage.
Cut it down.
Cut
it down. I want it, but I don't think it's going to happen.
It's like if you're in sales, it's not done until it's done, right? Show me the order.
Show me the paper. Show me the receipts.
Yep. That's it.
Yeah, that's right. So I wanted to know, I'm going to shift gears a little bit, because I love all these questions. I love this conversation. But debts like personal loans, HECS, and credit cards, those are all the things that people say they're going to hold you back. What is the reality of only having those things? Like, what is it costing you in your borrowing capacity per month?
So one of the things, as if you're approaching me as a broker, I'm going to tell you, leave everything in place. Let's do a full assessment of where your borrowing capacity is now, because most people can be surprised of what they can get additional borrowing capacity if they have some of these debts, right? You don't have to rush out and change everything. I've done a presentation recently about credit card debts, and then I had a client saying, I'm going to rush out and change my credit card limit. I said, I don't have your paperwork. I don't even know what your credit card, your borrowing capacity is. You might be able to hold on to your 20 grand credit card for the first property buy, the second property buy, and then you might need to change it. So let's not like throw the baby out of the bathwater here. Like, sometimes it's there for a reason, you got it for a reason, and everyone has their own reasons for it, right? So, but let's show you what the
well, it's not a limiting constraint, right? Like, it's not a constraint that's forcing an action. Like, that's one of the things that you kind of, I guess that's kind of what you guys are testing, is like, how much income have you got? Okay, well, that's not the constraint. How much ability have you got? That's not the constraint. How much actually the borrowing capacity is a constraint. Okay, well, what is the constraint that's holding that down? Oh, it's a $20,000 car loan. It's your HECS. It's that personal credit card that you've got that's pulling it down. Great. Well, what's the action that I need to take to solve that?
Right.
And
some of our big portfolios that we manage across trusts and personal lending and all that stuff still have a 20 grand credit card. Like, it's one of the conversations that you and I have had about the Oz property portfolio. We have one of these, I don't know, what are they called? What's that thing where it's a bank account and then you can go into the minus.
Yeah. An overdraft. Redraw or
overdraft.
Overdraft.
We have an overdraft.
Like, mate, you I'm like, I don't like this overdraft. I don't like it. And you're like, no, you can just leave it. Just there's no need to worry about the overdraft. But when you get there, anyway, more relevant is probably credit cards. What's this?
So
credit cards.
Click the right button. So we've done a preamble. You don't go out today and stop your credit cards and all that stuff. Like, this is just a model to show you what it can happen. So if we went from a 20 grand credit card down to a 10, we can increase our borrowing capacity by 60 grand. If we went from a 20 to a 5, it's a 90 grand increase in borrowing capacity for our gentleman here. So what it is that the bank doesn't care if you pay off your credit card every month. They don't care. They want to know what limit you have available that can turn into curtains and nights out on the town and all that other stuff. They want to know the limit. So the limit is what they take into account. Most banks will take 38% of the limit, or 3.8% a month. Some will take 42% of the limit, or 4.2% a month on their calculator of the limit. So it may not need to reduce it to nothing, but it does have an impact. And if we've talked about, like, the change of debt into deductible debt. Now we reduce the credit card. Now we've gone from 119,000 increase in borrowing capacity, and we're approaching the $200,000 increase in borrowing capacity, right? So we're compounding the effect here.
That's super interesting. Like 20 grand on a credit card. Oh, I only have $1,000 on it. I pay it back every month. It doesn't matter. It's your 20 grand that's the most important. But it's also it looks like it's 4 to 5 times the difference. So like a 22 grand credit card would be almost 100 grand in servicing that you've just all of a sudden gotten back.
Yeah. So if we take the examples, we've got owner occupied debt to investor debt. Now we've reduced our credit card. Look what we've done to our borrowing. We can go further. What's the car loan and personal loans, right?
Yeah.
Here we go. Car finance. So I have to put it in car finance because some people think their car lease is not a loan. It's actually a loan and it impacts your borrowing capacity. So car finance of 60 grand. If you get rid of that, 98 grand up. So now we've gone from 110 to changing debts around. We've got our credit card at 60 grand, and now we've got 98 grand by dealing with the car finance. We've got 74 grand by dealing with the personal loan finance. All right. And there's a couple of ways that you can deal with this. You don't you're just going to whip 60 grand out of your back pocket and throw it off the car loan, right? But if you've got a genuine intention to need to go down the line, you're going down the line in property investing, and you've got some equity, like you've got 60 grand equity that we can consolidate the car or consolidate the personal loan to help open up the borrowing capacity. It doesn't mean that you have to pay the car out over 30 years and be worth a paperclip at the end of the 30-year term, but it means that you can get the next property and have the uplift, but you can still pay it off in 3 or 5 or 7 years, depending on how you want to do it. Or you can just get rid of it, and it's up to you. So business debt, go for it.
That personal loan there, $30,000. So what you're saying is, if I didn't have it there, I'd get an extra 74 grand of borrowing ability. But if I just if I went to you and I'm like, great, I've got equity, I just can't access any serviceability. Why don't I get equity out, pay down that loan with my $30,000, and then that's going to open up. Yes, I'm going to have that $30,000 worth of debt. So how much of a problem, so this is personal debt versus like credit cards and car finance and personal loan. What about $30,000 of just household investment debt? What is that worth from a borrowing capacity standpoint?
As in, we get $30,000 worth of investment debt, or we're putting the $30,000 personal loan into the owner occupied mortgage?
I guess it's both. Like, what is an extra 30 grand of investment debt worth, and what is 30 grand worth of owner occupied debt worth?
That's a tough way to.
I'm just trying to think how. But if we could take the simple approach of going, we've got a $74,000 uplift. So if we take 30 grand of it, we've still got 34 grand left. I'm getting my numbers right. 40 grand left, 44 grand left.
Yeah.
So 44 grand plus the reduction in your credit card plus the change of owner occupied to investor debt is still compounding the effect to be able to borrow more money.
Yeah.
Yep.
Well, so the way that I think about it, and what the bigger impact is, it's the monthly repayment and how that's essentially what's impacting your borrowing capacity. Because the thing with those personal loans versus car loans is typically a personal loan needs to be repaid generally a lot quicker than a car loan, from my understanding.
That's right. Both car and personal loans can go over 7 years maximum. Typically, most people will take 5 years or anything less. Personal loans are unsecured, so they're usually upwards of that 15% mark, and car loans can range from anywhere from like 7 to 10 or 11, depending on credit profiles, because it's a little bit more of an assessment of you as a borrower versus the asset and the length of loan.
Yeah. There's so many questions flying through. Everybody wants to know. I think this is a really big one. And we've got some guests. Impact of children. I think from memory, it's about 60K for one. Is it 90K for two? Is it, Aaron?
Let me
for a friend.
So I'll just adjust my guy to have a dependent. It's about 45 grand.
Oh wow, okay. And
so
for two?
For two, I think we get a discount for two.
A discount.
Yeah, discount. Well, that's good.
Sort themselves out off that.
Yeah, the big one can look after the little one.
let me just quickly do that.
So anyone that's got any kind of questions, guys, any smart questions, dumb questions as well, like don't feel like you're going out there and putting yourself on blast. Throw them out there because you've got a good opportunity here to take advantage of a smart
and
a smart
I want to
mind.
know, this is on as well. Show us a big increase for no HECS. Is HECS actually that big of a contributor, Aaron, or what does that look like? Hopefully you've got those numbers.
HECS is not as much. So about 25, 30 grand for a child. Second child goes to
25 to 30 grand. But it's also a contributing factor. This whole HECS thing's like, oh, it's not that much. But we've got
second child 84 grand off your borrowing capacity for second child.
Wow. Okay, so it's actually just almost as much for the second. There you go.
Sometimes I want to sell my kids off, but I can tell you,
they're a productive asset for sure.
They are good. They're good. I love my kids. Cool.
So HECS, do you have
HECS? So HECS is really interesting. So we've had situations where we have a couple. One applicant has like a 200 grand income, and another the other partner has like an income of 40 grand, and the person earning 40 grand has a HECS debt. But because they're underneath the repayment threshold, HECS doesn't play a factor in their liabilities because they are not at an income level that affects the repayment. So HECS in that case, not going to change. But if it was reversed and the HECS debt was on the 200 grand income, yes, it does play a factor because the banks use gross income, they take tax off, and then they match it to the repayment tables of the HECS. So a couple of years ago when the indexation was up high, HECS was affecting. So when it was at like 7.1, I think it was, when I last looked at a HECS statement, 7.1 a couple of years ago, it was showing us that we probably should look at debt consolidating it because home loans were cheaper. But then the government changed their things and now it's down at 3.5 or under 4%. So it's actually a cheaper debt to have there. If it usually is one of the last debts that we go after to change because it's less impactful on borrowing capacity depending on your income level.
Well, one of the things that I'm trying to think through is like, how much of a difference does just negotiating a better rate with the bank? Like, people, I feel like when interest rates were dropping, were rising, people were like negotiating, and now we've kind of gotten to this lull moment. I just don't think people have called up their bank.
I think we're in the period where we're going to get a flush of people wanting to get better rates. So there are some banks that are doing discounts prior to any rate cut. There is this fixed rate curve out there that the fixed rates are for owner occupiers less than 60% are like 5.5 or less. But you've got to think the banks are getting money from offshore. So offshore has reduced their rate, and the variable rate onshore is usually, so the variable rate typically is on the RBA, and some of the fixed rates can be mixed funding from offshore. So that's why some of those fixed rates are getting less. Maybe it's a tip that rates might come down as well. We don't know. But you can still ask for a discount. We've been asking for discounts for a bunch load of our customers recently to be able to see where they're at. We're monitoring a lot more loans to make sure that we are comparing to that. There's literally nearly 90 or 100 lenders in Australia. So you've got to keep comparing to things and be ahead of, as a broker, I want to be ahead of the customer. But customers can ring up their broker, get them to do a rate or pricing adjustment. They can ring up the bank and do the same thing. They can keep could bring out the old negotiate your loan again details off one of the posts, but ring up and ask. You never know. You might get 0.1, 0.2, 0.05, point whatever. If you get
if we get 0.5, like that's a lot of money. Like you've got $1 million worth of debt and 0.5%. How much of a difference does that make from an overall borrowing ability though? Like if we drop it down by 0.5, does it like, oh my gosh, holy shit, this is a lot, this is going to open it up? Or Jeff, you're shaking your head like you've been asked a silly question.
No, it's not silly, but yeah, I'd like to say it does, but I suspect it doesn't do that much.
What we've got to do with affecting borrowing capacity is do multiple things at once to be able to do it and compound it together. With just a simple analysis on a model that I have to be able to do this, if we take 0.5 off,
20 or
each
30.
bank's going to change. Maybe about we're looking at probably about 20 grand, 20, 30 grand.
What, 0.5% gives you 20, 30 grand?
Well, I'm judging that off good old Ubank. Ubank was only increasing by 20, 30 grand. Yeah.
Owned by NAB.
Thank you.
Yeah, So I want to crack through some of these questions, and we've got some really good questions on increasing the borrowing capacity. So this is an interesting one because I don't think it doesn't looked against unfavorably, but I think it's just there and it's factored into your circumstances.
No,
so the question is, does owning debt get looked at favorably by banks?
So I suppose two things I've seen in this is if you don't have any credit and you go out and you get that good old credit card so you can have a credit rating, that's a big furphy. I'd rather you not have any credit before you come and buy your property portfolio because it's good. No history is easier to explain than history. Having debt is not going to be looked at you unfavorably as long as you've got the income to be able to meet the borrowing capacity that you want.
Yeah,
easy as that.
We have been asked lots of questions about SMSF DTI, and we'll get to. I think the answer to that is it might be surprising. Somebody asked about crypto and what that looks like from a lender. I would say it's like going to the casino, but maybe own an NFT or two. Joe says so. Well, let's ask.
Okay, so let's ask the question. So let's say I've got $10,000 worth of crypto.
Worse, maybe.
Is it thought as stocks and shares and any other asset, or is it looked? So is it frowned upon?
It's the same question. If you want borrowing capacity, you need income, and investing outside of property, the income comes in the form of dividends or the dividends change. So if you get dividends of $4,000 a year in 2024 tax year, and you're going to get $4,000 a year in 2025, the lender will allow us to add $4,000 of investment income into your calculations. But that $4,000 may have been earned off $100,000 of invested money because the companies weren't providing dividends at that time, right? When you have crypto and capital growth shares, so shares that don't provide income or dividends and they just capitally grow, we can't put capital growth out there. It's a bit like I'm going to hold $100,000 worth of US dollars, and I want that to affect my borrowing capacity. Well, it's not. It'll help you with the deposit if you convert it back into the right format. Crypto will help you with deposit if you convert it back into the right format to help you buy the property. Property still has, in generally speaking, property still will have a bit of an outperformance on the long term over shares and crypto and things. So there's a bold projection.
I didn't hold it the last week, Aaron.
The bold call.
Long term. Crypto doesn't have as big a history as property.
It's not going too well at the moment, but anyway, we won't talk about
it. It's not. There you go. One of the things I just want to dive in a little bit, because I know we have a lot of business owners on the podcast, and probably on this live session, because how should we think? So this is a two-part question. This is one part of it. Does maturing ABN improve rates or simply open up more lenders? Say the business is between 12 and 24 months. Can you just kind of shape that? What if I own a business that's before 12 months? Like I own a carpentry business, a plumbing business, a marketing business, and I've owned it for 9 months. Can I go out there and buy a property? Like, what's the general consensus against that? And then let's answer this next one, because that's the next time period and phase.
The answer to the question is yes.
You can still lend at 9 months.
Yeah.
How?
You can lend at 1 day ABN.
6 months, can't you? Yeah.
We have lenders that will lend at 1 day ABN.
I think I might know it. Might start with R and then D.
So to expand on this question, does maturing ABNs improve rates or simply open up more lenders? So it opens up more lenders that have better rates. To rephrase it. So 18 months is the sweet point for most major banks to get the lower cost lending.
Yep.
And 1 year of good tax returns. So you've got to be careful. We run on a financial year. So if you if you can magically start on the 1st of July, it makes most common sense to be able to get a full tax year in your in your numbers. But if you start like March of 2025 and you do your 2025 tax return, we've got annualization of only 3 or 4 months of earnings, right? So you've got to be careful with that. Less than 18 months, there are things that we can do, like looking at bank statements, business bank statements, so credits in, debits out. We can look at that to service the loan. We can look at business activity statements to service the loans. For the professions that you've mentioned, they probably do need to wait for the maturity of their ABN to get the lower cost lending, but we can go to BAS lending and accountant verification lending and bank statements lending easily on that stuff. And there are some professions that may convert from a employee to a business owner, and we can lend straight away with major banks. So we've done it where IT professionals come from a 200 grand employment package, and then they go on to a 260 grand contractor back to the same company or wherever they need to, and the bank will use the lower of the two. So if they're earning 250 in their business and they were earning 200 beforehand, they'll probably just use the 200 to service it, and we can still use major banks to do that.
So okay. So it just opens up. So the later the business is,
it opens up.
Yeah. Okay. So what if the profit is unreal? It's not so much about that. It's more about the.
So profit has to be there. Profit's where your loan repayments come from. So the bank's only looking at profit. So if you turn over 100 grand and you spend 95, you only got 5 grand profit. If you turn over 100 grand and you spend 5 grand, you've got 95 grand towards you. So
this is one of those. Can you talk to that a little bit more?
Yeah.
Because
okay,
I remember when I was 18, I was looking at carpenters and sparkies, and I'm like, why? How have you got the nicest car in the world? Like, how are you doing this? Dude, I just write it all off on tax. I run my business, I write it off on tax. And this is not a go. This is just what I saw. But I'm seeing it time and time again, especially in the trades industry, where it's, oh no, I don't want to pay any tax because I want to write as much stuff off as possible. Why is that the worst thing to do?
Yeah. So it's a bit like cashies a good cashies another thing, right?
As well. Yeah.
Because your money that goes in your bank account from other jobs has to pay for the job that you got from the cash job, so your profit decreases over time for the long term. The thing comes in is about the top. Your turnover is only created by you spending money to get it. So the banks will look at your net profit before tax. So I've seen companies that turn over $1 million and spend 900 of it, and they've got 100 grand profit. And then I've looked after companies that turn over $500,000, but they only used 50 grand to get the $500,000. So out of those two, the person that turned over $500,000 has got a huge borrowing capacity compared to the one that turned over $1 million. And when you put all this expense onto your business, it erodes your profit away. Yep. So I'm going to buy the fancy car. Now that's costed me 50 grand on my profit. I'm going to put the subscriptions, the cars, everything like onto the business.
Life, right? Like the personal life. I see so many people cross their business life and personal life. I still go out and have client meetings, and I'll pay for the beer myself rather than, because I want my business to be as profitable as possible. Mm-hmm. But what that means is I'm not getting tax. I'm paying a lot of money in tax because the business is so profitable.
So there are businesses you have to get assets. You have to get car finance. You have to get things like trades businesses and things like that. But there are lenders that accommodate those sorts of things. So we've got lenders. If you can show profit on your business and you paid yourself a decent wage, you've got some profit left, and you've got business debts, as long as you've got profit, we can exclude the business debts. So there are lenders out there that can accommodate for large asset and equipment finance and things, because you need that to make the profit.
Well, it's more from a mindset side of things, I think. Where I see people is, I need to pay down as much. I need to pay as little tax as possible, because that's what's going to allow me to live my best life. But what it does is, with that mindset and with that, because you chat with an accountant, that's what they're going to say. No, you want to pay as little as tax as possible. You want to pay as much as tax as possible, because that means your net profit has more availability, which means that you can then borrow money to go out there and buy property. If your net profit is at 0 or less, it means you're a losing business, and the banks are going to look at you and not want to lend you any money. So get that net profit as much as possible, and it sucks because you have to pay the tax on it, but you will be able to compound that into a property, which will then be at a far better rate than any tax that you've paid. So if you have to pay tax, be thankful you're making money. But then there are ways to reduce that debt and do all the tax stuff as well.
Speak to your accountant. Definitely speak to your accountant on that.
We're in a unique period of time for small business owners, because we've had we've had about 6 months of trading so far on the profit and loss. So if you are planning to buy property in the tax year 25-26 and you need your 25-24 tax return to do so, you have 5 months to affect your profit now. You have the ability to review your finances. You have ability to, I call it not tax minimization, balance your tax to your borrowing potential. So maybe paying $500 in tax or $5,000 in tax is going to let you get a $1 million property that's going to increase in value. That could be the numbers you need to know. And if you needed to get 10 grand net profit extra between now and the end of the financial year to get your borrowing number, you either need to cut your expenses to get that 5 or 10 grand, or you need to know, if I earn $1,000 on my turnover, how much did that $1,000, how much did it cost me to get that $1,000, and what is that $1,000 going to do to my net profit to be able to affect my borrowing capacity? And I don't know any business owner out there that if you are just off, you're getting your number for borrowing capacity and you want to buy property in 25-26, you need to get your borrowing capacity reviewed today. Because just as we help the employees out with their annualization of their payslip, which the banks accept, what if we were able to get ahead of the curve and look at annualizing your profit and loss to see where you might land at the end of 25, to see what you might need to do now for the next 5 months?
Yeah, I love this. We've gone down a bit of a rabbit hole. So somebody's called us out.
Well, this
and
is
said,
a business rabbit hole. I think there's a lot of business owners in here that probably would have shaken them a little bit to be like, oh shit, why am I not trading profitably? I want to keep going down this rabbit hole. One more question. Sorry, Jeff, I know you don't like this rabbit hole, but we're over time. How do you think about the money that I make as a salary that I pay myself as an employee in my business against the net profit? Is this the way I understand it? Is, let's just say I pay myself $100,000 in my business and my business makes $100,000 of net profit. That then merges together and essentially I have $200,000 worth of borrowing capacity. That's how I think about in my mind. Is that the correct way of thinking about it? That is the correct way to think about it, because
I could pay myself 28 grand of personal income for the year and I could have $1 million worth of net profit. And basically I'd have $1,028,000 to go to the bank with to get borrowing. It's because I control the business. If you control the business, you control the profit and how you can get it out to pay the debt. That's how the banks look at it. How can you pay the debt?
Love it. I want to talk to self-managed super funds. Jeff wants to talk about something. We've got to run this ad, so let's rock and roll, and then we'll get to these questions that you guys have. Throw in some juicy ones as well, because we will answer them, maybe. Ladies and gentlemen, we have a special announcement from the Master of Commercial. The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia, and not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
So we're back. We are going to talk about SMSFs. So definitely,
cool.
and trusts as well, because I think those are ways you can potentially increase or borrow more in 2025. But one of the things that somebody's talked about, and I think this is not necessarily for everybody, but somebody's asked about renting out their PPOR, because I think that's a somebody said here, we did talk about this a little bit earlier, but unpack, keen on hearing from borrowing capacity. If we rent vest, will it improve borrowing capacity? I think it was is that the same as if you get rid of the debt, Aaron? Like what does that look like if you rent vest?
Rentvesting by converting your owner occupied into a rental, that can be quite good, because you now got deductible debt. You've got to make sure that you've got the right benchmarks for that, and you're going to rent. So you just got to be careful that if you go and rent at $1,000 a week and your mortgage was $700 a week, that can be a disaster to your borrowing capacity. But if your mortgage was $700 a week and you're going to rent at $500 a week, or $1,000 a week, you're going to get in and you're going to pay $500 a week in rent, that is a different scenario. So that's what you've got to take into account when you convert your PPOR into a rental. But you might have other reasons, like closer to work, opportunities, pay rises, other things that may turn that into a better investment for you, a better decision anyway.
Yeah. Well, what are the because the other thing that I was going to say about, like, how much, because for those people that may have only used one or two brokers in their life, and they may not have gone beyond the big four banks, or maybe a St. George, or what is that? How much does the borrowing capacity increase if you start to go down the different tiers of lenders to your Liberties and your La Trobes, those sort of lenders? What does that look like?
So let's make it really. We'll give you some numbers on this one, because one of the things that I saw in some of the comments before we did this presentation tonight was that the banks needed to reduce their buffers from 3% and move them down. So APRA is the regulatory of the major banks, and they've said, we're not going to change the buffers from 3%. They're going to always be 3%. But did you know that there's lenders out there that are not regulated by APRA? So here's some changes. This is two lenders.
Their rules are completely different. They don't have to have any buffer.
So there is a product out there, non-bank, that has no buffer, but you probably got to take a 5-year fixed rate to get it. There's lenders out there with a 1% buffer, but just to show you from, say, major bank at 3%, we can get this much borrowing. We go to 2%, and we can get another 110 grand by just changing to a lender that has a 2% buffer instead of a 3%.
So if it goes to 1%, does that then double again? Does that go to 220?
Yeah, you can take that mathematical equation to probably double it, but the problem is that those mathematically it works that way, but not with the lenders, because when you go to the lenders with 1% buffer, the interest rates do increase. So the less restrictive lenders on borrowing capacity know that they're the only ones out there, so they give you a nice little gift of extra interest as well.
Oh, of course, I love paying extra interest.
Yeah, well, it's interesting because we look at the Oz property portfolio, right? Our average loan is 7.29 across the 4 property portfolio. Actually, I'll just double check that.
I think this one is in 6s, isn't it, Joe?
Is it? So I might be wrong. Oh, sorry, 6.97. So we do have a 7.29, a 6.69, a 6.65, and a 7.26,
which is pretty competitive.
What's 7.29? And we are under a trust structure, which we'll talk to.
So let's get the.
So we won't talk to the trust structure. I meant as a later on session, we'll talk about structuring the portfolio and stuff like that.
So you can take. Here's the strategy. When you take a loan at 90%, for example, on an investment property, and the property performs and increases in value, and you're a few months into your new loan, maybe 6 or greater, or 10 or greater, or 12 months or greater, depending on the bank's rules, you can revalue the property with that bank. And now what was 90 now is 80. Guess what? That rate can drop, and other lending opportunities might come out. An example would be Macquarie doesn't like to do interest only when you go over 80% loan to value ratio. So it's principal and interest. So when you're able to revalue it back under 80, you have options to change it up and reduce the interest.
Okay, so we have the Oz property portfolio. We are in the 7s. At what point should we be knocking on Aaron's door and saying, hey, Aaron, it's been 6 months since we bought this property. Should we be refinancing our entire portfolio? Is that going to be something that we should be considering? Or
May not be necessary for the whole portfolio, but we could investigate those higher rate ones, knock them off one by one, get them down under the 7. That will improve the cash flow, get you towards the 150 grand a little bit quicker. And that is due to the choice of property, and the equity has to grow upwards to be able to change the loan to value ratio. So most banks, if not all banks, are going to loan to value ratio pricing. The best pricing is 60% or less. Then it increases a bit when you go over 70, and it increases more when you go over 80. So you can do it in stages. We can start at 90 as acquisition, come down to 80, better rates, then it performs better, come down to 70, then come down to 60. So as rents go up over time, rates come down over time, and you can run closer to that 150 grand passive income.
So that was one of the actual core reasons why. So if we have a look, I'm just going to bring up the Oz property portfolio right now because we're not over time, and I haven't upset Jeff enough tonight. We can see the Oz prop portfolio. We've made some decisions with our LVR. So the most recent purchase, which is Melbourne full reno, we bought this one for 540. We actually got a $10,000 discount, so it's actually at 530,000. We decided to do this one at an 80% lend to be able to get access to a much lower rate. Because I don't know if you remember what the rate was with the other lender when we did it, Aaron. You were like, it was high 7s, and we could have paid the extra to get the to drop the LVR down. So we paid more of a deposit to get a better rate. So there is, like, as a property investor, you do have to weigh these things up, right? You have cash and equity, we have borrowing ability and serviceability, and then we have cash flow. And as Aaron said, kind of alluded to at the outset, is you don't need to sell down on your credit cards if you don't need to. We have enough cash and equity to be able to do that, and it gives us that better rate. So it's worthwhile doing it. So there's no question in that. That was more of a statement. But the question I do have is, we bought that property for $530,000 on RP data. It was valued at 605. It's a shit show reno. We're going to spend, how much are we going to spend, Jeff? 60 grand on the reno? 60-ish?
Yeah, 60 is the quote. So hopefully it comes in.
So right now it's going to be worth so much more than what we valued it. Should we go get it revalued and go reassess this loan?
You can do it. You can do the revalues if you're with. I know which banks you're with, obviously. So I'll make it a bit more general statement. If you go to some of the non-banks, they're going to charge you for the valuation. If you go to the major banks, a lot of the brokers will get the valuations for no cost. So where the valuations are no cost, we should do revaluations and put in valuations and pricing along milestones. So if you are if we've had it for months and months on end, or a year, 6 months to a year, we should do the valuation. If you are going to increase the value via renovations, we may wait till the renovations are done and then we'll revalue it. And it is worth paying for.
How does the valuation work from? So we purchased it for 530. Obviously, it was only it was only a week ago. It's now valued at 605 on RP data. Is that how I should think about it? Oh, wow, RP data values this, and that's what the banks use.
No, you've got to use the bank you are with to get the valuation done, to drop it down. So it can be an automated one, it can be a desktop valuation, it can be a walkthrough one. All of those with the bank that you're with. Even though Heron Todd White might be the valuer across all the banks, it has to be the one that says ANZ Bank, CBA Bank, St. George. So it has to be the bank's valuation, not our RP data or anything like that. Yes, they do rely on that data, but they will rely on three or 6 months in historical sales, not looking at what's on market or what's about to settle. It's all what has settled.
So if I buy a property under market value because I'm a very, very good investor, and a property just down the road sold for $100,000 more, should I go out there and celebrate and go, oh my gosh, last week this one just sold, should I go refinance it? Or you've got to wait a little bit of time for that to flush?
I think everyone should celebrate everything that they can. But if the property down the road got 100 grand, they sold it for 100 grand, but it's not on the RP data statistics anymore. It's still in a cool off period. It hasn't settled. I wouldn't count your chickens on that one. I'd wait
You have
till
to wait
it's
3 to
settled
6
and
months
it's
at least.
on the data. And if the whole town sold for 500,000, then you got this 1 million in there. It's not that you're going to have a 500 grand uplift overnight. It's going to average out across the whether it's inferior, superior, and all that stuff that we see on valuations. So
I've been
when
hogging
you
all
get a
the questions.
reval, so the key is if you want to get your rate down with your current lender and you believe you're at 60% or 70% loan to value ratio, get them to revalue it.
Well, we will be at 60 after this renovation. The reval should come
We
at
should
around
reval.
the 650 mark because we're turning it from a 3-bed to a 4-bed. It'll be around the 666% mark.
So we should be able to get that rate down for you, or change it to another lender, because that's where competition comes in. Like we're not going after big rates all the time for investors. We have to go through the consolidation, get the rates down, so that you can go out and get more. So you're getting closer to the 150. So yes, do the reno, we revalue, and we get a rate down. The other ones that are over time, we've got some time, we revalue with the bank and we get the rate down.
Okay, yeah. I'm done with my questions, Jeff. I've hogged them all. You can ask your ones.
I don't know. Anyway, so I wanted to deliver value and how you borrow more. I'm not saying that's not, but yeah.
Oh,
anyway.
well, there's a question that's popped up. Guys, let's come back to the topic of this live. If income stays the same and properties stay the same, how do you borrow more? Is it just pay down different debts? What if there is only property debt? How do I borrow more?
That's what I actually covered off. That's why I said different lenders, different tiers. I was going down that path.
Yeah.
That question. Yeah,
cool.
Anyway,
you got it.
Answer the question.
So different lenders, different tiers. And you know, the thing that's not talked about in investor circles is actually if you repay debt, you can borrow more.
Okay, so
I know that's a bit interesting to think about.
What does that mean? Talk to me about that.
So if you've only got investor debt left and you've got surplus money, you can build up your offset accounts. You can build up different things, and depending on where you are in life, you might want to start retiring the debt. Like, are you going to have a massive lending amount on your Oz property portfolio when you retire? The answer is no. You've got to retire the debt at some point. But if you've got the surplus income and you only got property debt and you want to borrow more and you can afford to repay some debt, that can increase your income, because what's better than an investment property with a loan on it is an investment property without.
Okay. But then you've got to have the capital to be able to afford that, right? Like it's
Correct. So how do you borrow more? You have to diversify your lenders is probably the simplest answer to that. Or repay your debt.
Earn more income. Earn more income.
Yeah,
pay down all the
income,
terrible debt. Earn more income.
Earning more
pay down
income,
the bad debt.
Income just trumps everything, right? Earn more income. Like if I've heard property podcasts recently that go through if you increase your income over time from when you're younger to older, it allows you to borrow more. Having a partner with an income can help you double down on property too. Offloading the kids after school and they've got their own jobs and you paid out your private school fees, that's going to increase your borrowing as well. So it is more, if you can't borrow any more money from a traditional bank or even the non-banks, you're going to have to decrease the costs that are associated in your life. And it's not living expenses because the banks have minimum benchmarks on that. So you can't go down to $1 living expenses. The bank will judge you at a higher amount. So if you're on a fixed income and you can't pay down your debt and you want to borrow more, diversify your lenders.
Well, or also, even diversify. I was going to say diversify the assets. Like, what about if you have money,
granny flats, add value, all that stuff.
Commercial as well, like lease stock loans. If you've got
lease stock loans are good.
Actually, that's a very, very good point. That lease stock loan point is spot on. Do you deal with that much?
Yeah. So here's a really cool thing about 2025 for you. Lease stocks are traditionally on commercial assets, but did you know you can get lease stock on residential assets?
Are you talking about unit blocks?
Unit blocks is the most common one. So if you got unit blocks, most lenders greater than 4 and 1 or 4 and a line can get a lease stock, but we're doing a lease stock at the moment for a duplex.
Wow, there you go.
A new duplex? So, like, how the hell do you do a lease stock against a duplex? It's very negative.
So lease stock is really interesting to think about. If you think about it, the rental income becomes like the payslip for the loan.
Yeah. Yep.
You're not going to get 80%. Because on a residential property, you have to pay the landlords, the insurances, and all the outgoings go onto the landlord in the most point. So you're probably only going to get a 50% LVR at most to get a lease stock on a residential property.
Right.
Yes.
That's cool. So, I guess so I was having a chat with an investor, and they were building their portfolio. They've got 5 or 6 properties in their portfolio, and they're like, "I'm totally tapped out, dude. I can't borrow anything more." Great. Well, what are you going to do? I've paid down my debt. I've done this. I've done that. I've done this. And then the conversation went around to lease stock loans, where you can get a commercial property based on the value of the loan, and it becomes a little micro business in itself, and the bank will lend against the business of the like the actual commercial asset.
That's
and
right.
he can automatically take that debt on because he's got a lease stock on it. So those that think they are stuck, maybe you're stuck in residential, or you're stuck in, we're just talking about duplexes and units, but you may be open to commercial lending. So have that conversation again with your broker.
And commercial lease stock is awesome because we get the net GST of the rent, but the outgoings in most cases when you investigate the lease agreement go to the tenant. So it increases your cash flow straight away. So that can go on to the lease stock, and most major banks do the lease stock. Most investment service brokers are accredited in commercial to help you out. There are so most commercial lease stocks with major banks will last for the tenant term. But there are a couple of lease stocks out there that are, if you've got greater than 12 months on the lease, they'll do a set and forget 30-year mortgage for you.
Happy
on commercial.
Yeah. Done. That's how you get your extra lending. You want extra lending? Get a lease stock. Get a good asset. Super interesting. The other thing is income will increase over time. So I know, like, what I see a lot, like we have our deal crunch calculator that we give away in the Oz property community. I like it, but I don't really like it because it doesn't factor in residential, like the rental growth over 10 years. It doesn't factor in interest rates. Like it's factored in 6.5% interest rate, and rents are going to stay the same, but it's not. Like rents will increase. Your loan, like over the next 12 to 24 months, interest rates are going to come down. Not as crazy as they went up, but they will come down. So you've got to kind of roll it out over the next decade. Like it's like people that were banging on about Townsville. It's like, yes, there's going to be a bit of a blip in the data, but you're not buying for 5 minutes. You're buying for 5, 10, 15, 20 years. So you need to look at it as a bigger picture. Same with every deal that you assess.
And lease stock, just as a trap for new players in lease stock, most of the time the lenders will want you in a corporate entity, so a company or a company trust, to be able to, what they say, ring fence it off. So if you're an employee and you want lease stock, you can get it, but typically you have to hold the asset in a trust or a company.
Yeah, right. Okay. Well, that's probably preferred anyway, because it's a bit of a dangerous, it's a bit more of a liability anyway,
Correct. Yep.
Commercial.
Yeah. So let's look. We're almost at the hour and a half. We like to keep those at these days, but let's quickly touch on SMSF. And there was another really good question. If somebody sees another really good question, we'll get to it. But I think several people asked this, and I don't think there is a debt to income ratio for SMSF. Is there?
No,
Aaron?
There's no debt to income ratio is typically for your it's not for your SMSF. There are other levers that the SMSF guys have. So they may have what they call a liquidity test at different, usually at higher loan to value ratios. They they still have the normal servicing. They'll still have some caps on rental income. They'll have the ability to do commercial, all that stuff. There is greater than 12 lenders out there that are doing SMSF.
Yeah.
It's not the major banks, so not many people see that.
Would you say greater than 12? So there's 13?
There's last time I checked, there was 12, but I knew there was a couple of others coming out on the market. Yeah,
that's a good number of.
That's great. This is becoming so much more popular. Self-managed super funds, and we've done a lot of sessions on self-managed super funds that you can kind of get the breakdown on.
I did want to ask about trust and what it looks like, but I think we'll have to do that in a mini session. So make sure you subscribe to see that, because it's going to be. I think it's important that we talk about.
To what?
Subscribe to YouTube, subscribe to wherever. Just hit the like, all that stuff. I wanted to know this. I thought it was a good question because Aaron has, and I've talked about this recently.
Very good.
Should you max out personal borrowing capacity before trust SMSF for investments, or is there a time or circumstance where you should consider trust and SMSFs earlier?
Very good.
I reckon we've got to split that. So
exactly.
You can run So mathematically, you can run out your personal borrowing capacity and still have borrowing capacity in your self-managed super fund because it's an isolated borrowing capacity area. It's also, to make a note on self-managed super funds, there are some calculations of how you can get your borrowing capacity in self-managed super funds, but self-managed super funds aren't called non-NCCP loans. So we are actually able to use future contributions in a few lenders will allow us, if you're ready, willing and able to put salary sacrifice in, they will allow us to put that into the calculator to max your borrowing capacity a lot more. So that's an interesting factor versus the traditional method of looking at history. To run out your borrowing capacity before you get trusts, you're going to get stuck. So to go after a single residential property in a trust to help extend your borrowing capacity, you have to have personal borrowing capacity left to do it, because the trust is typically new in origin, and it requires you as the director and the guarantor of the trust to support the borrowing for the trust. So if you've got anywhere less than $1 million in borrowing capacity but greater than $500,000 left, you probably need to seriously consider thinking about how the borrowing capacity numbers work, because as a broker, we can't tell you go to a trust and do a trust. We can tell you what the impact of your borrowing capacity is before you do it. I have a lot of clients that come and say, oh, my accountant said I should run out my personal borrowing capacity first. That's a wrong move. If you are buying residential assets, you have to have borrowing capacity left before you buy in a trust.
Okay, so let's run the scenario. I just maxed out my borrowing capacity. I'm like, cool, man. I just watched this live session on the internet, and they said I need to get a trust. I'm maxed out personally. I come to you. I've just bought a trust. Let's go buy some property. What are you going to say to me?
No, I'm going to say lease stock's your only option.
Yeah. So
because
typically,
lease stock gets away from your personal capacity.
So what you just said there, more than $1 million, you find less than, so in between 500 and $1 million of borrowing capacity left. So it sounds like it's the second, the second to last property purchase that you need to start considering these trusts.
So what I'm seeing at the moment with the people getting stuck from the people coming to me, an owner occupied in an investment property usually is slowing you down. So you probably got to, there's always a benefit of having something in your own name. If you have a highly negative geared property in your own name, it's better than a highly negative geared property in a trust on the mathematical calculation. So
why is that?
Because in a trust, the losses stay in the trust, not able to be taken off your personal income.
Yeah, so you can only deduct it if you have another asset in the trust.
Yeah. Yep. And the lenders know that too. So $1 million worth of borrowing capacity in your own name turns into maybe 760 in a trust, because they don't allow you to add back the interest to supercharge your borrowing capacity. So
that's a problem if you get into trust too early. So
correct.
First property purchase, I'm like, I heard this whole trust thing. Screw it. I'm just going to start with trust. Jesus, this property investing thing's gets complicated
or costly. So you got to have a plan. So it comes back to the beginning of the session. Have your goal. Trust that the first instance could be a good thing. It's not wrong or right. It's understanding how to manage the thing, having a business plan, having a case that puts it forward. It's like people having a property in each trust. Yeah, that might be really cool for borrowing capacity, but the accountant loves you. If you've got 10 properties, right? That's 20 grand out the window, potentially. So borrowing capacity, it's a way to manage borrowing capacity, and there are a lot of lenders out there that still allowed to isolate trusts, but they've got to have profit. You've got to be thinking, I'm going to put this property in a trust. I'm going to have 90% lend or 100% lend, depending on how you want to do it. And you're going to have it negative. Well, you're not going to be able to exclude it because it still needs you to support it. But over time, that will help you, that will get to a pathway of profitability so that you can include it. And the reason why when it's profitable, so a $5,000 profitable trust with a 10 grand interest cost in the trust's profit and loss is profitable on paper. But as soon as we put the lending onto the banking calculator, the income of the rent drops by 20%. The interest jumps up to 30 grand from 10 grand because they look at the remaining principal and interest terms. So what was $5,000 positive is now 30 grand negative. So the property in a trust, when we can exclude it, can help your borrowing capacity as we look to more in property trust 1 and or trust 2.
So these are some of the scenarios that you kind of map out with folks, right? Like I've got $1 million of borrowing capacity. To be honest, we're going to get you started with an asset that's going to allow you to get, because it's what does this next property need to be to get into the next one? So we'll buy $500,000. You'll then come back to us. We'll be able to borrow $700,000. Maybe this is when we consider the trust. You then need to focus more on maybe a growth/cash flow asset that has some value add potential into the future. That's then going to allow you to do a granny flat or a subdivision or something like that, which then could turn that trust into a cash flow positive asset. That asset that is now in the trust is now completely excluded from the debt situation. You now have $700,000 worth of borrowing capacity because that trust may be able to wash its own face, and the lenders will be able to lend you the money that you need to do. So you now all of a sudden are not the person that's jumping on our Facebook group saying, I've totally tapped out. You're not.
That's right. So even if you think you're capped out, you're usually only capped out when you bought your property portfolio and now you have half your income. But where you got all your income that you had before when you borrowed for your property portfolio, you usually can find a way to get borrowing capacity back in one way or another. Trusts are great, but you can't run out your borrowing capacity. I can't stress that enough. Don't come when you are run out, even though that we have tools, trips, and tricks that we went through tonight. You still have to have borrowing capacity to buy that single residential asset that you want to buy in a trust without going down the line of lease stock.
Well, and this is the beauty of the client, like people that are still on here. Great for you to stick around. You are true property investors. It might be at a point where you need to recycle an asset, right? Like people who bought heavy in some areas that have had 60, 70% growth. Is that the best market now? Like, is that the best utilization of that capital? Because you can't borrow any more money. You're tapped out. Well, if you sold an asset, that's going to open up $500,000 worth of capital that you didn't have in a trust that you may now be able to put into a trust that you could then future do it. But it's all kind of strategy and that kind of thing. I think that this has been an unreal session, mate. We have gone very, very deep into questions. And how should people get in contact with you? And can you help us out with these type of things?
We definitely can delve deep into your personal circumstances and how they make levers into your borrowing capacity to compound the effects, whether it's simple as a credit card or even into the trust 1, 2, and 3 and how borrowing capacity can work for that, or even into your SMSF and how that can be built out to multi-property portfolio with lending as well. So we can go delve into that.
What's the best way for people, Aaron?
Best way? So the best way would be to jump on to strategicmortgagebrokers.com.au. You can book directly in with a call for me. You will get me. So if you book in on the calendar links and things, you'll get me to have a chat. We have 6 mortgage brokers in the business and a bunch of support staff that are phenomenal. So we can take you on, get you the answers, get you through the system, and see where we can go to increase your next property portfolio purchase.
And I think from my perspective, whether you go with Aaron or whether you decide to use, look, of course we love Aaron as a broker, but just have that conversation. Like start thinking now if you want to buy, because you need to start making those moves 3 to 6 months before, in some cases, so that you can tidy up dot your I's and cross your T's. So you've got that all that in place. Because if you don't do that, if you just go to your broker in September this year and say, hey, look, I want to buy that property now. And they say, well, actually, no, you needed to plan out and fix up your expenses and all that sort of stuff. So I think it's important to start having this conversation now if you want to buy in 3 to 6 months.
Yeah.
Awesome.
That's a great way to end it. Unreal session, mate. I feel like this is like the foundation conversation for anyone to understand the broking world and what they need to do. Essentially, you don't really need to know too much, guys. Like, to be honest, some of this stuff is gone over a lot of people's heads. You don't need to know it. We've got people that are experts in their field. All you need to ask is better questions. What do I need to do to allow myself to get into this next property? Please help me. Please, please, please. These are my goals. So get crystal clear on what you actually want to achieve. And then you can reverse engineer and build a path to get there. Because if you want to retire in 3 years on $300,000 income, they're going to be able to run the scenario and say, that's not possible. What are you talking about? You haven't got enough capital here. Great. Now I can see that number is going to be reached in 30 years. well, okay, that's more realistic. Great. Anyway, Unreal Session, Aaron, thank you very much for sharing all your insights. Let's go buy a property and reach out to some investment savvy brokers.
And if you've gotten value from this session, drop us a review on Spotify as well, team. Let's go and buy a property.
Cool.
Go on, do it. See you, boys.